Hi everyone, it's Liana, ELA for Financial Information for Decision Making. This is a video basically covering ratios in preparation for your exam, so it's a refresher. I'm assuming that you all have a base knowledge of ratios prior to watching this video. It's just giving you some wonderful preparation before heading into the exam. So it's broken down into the 4 components that you did for your report. So your profitability, efficiency, liquidity, and gearing. So let's jump into it. Look at our profitability ratios. This is just in line with the ratios you used in your report. I'm not going to go over every profitability ratio because that's going to be an information overload, so we're just going to keep to the basic ones. So you all should be very familiar with these 3 ratios. This is just going to give you a refresher before stepping into your exam to make sure that you're on top of everything and you understand it all. So we've got our 3 ratios, which is our return on shareholders' equity, return on total assets, and net profit margin. We've got the acronyms that you can use here: ROE, ROA, and NPM. I've got here that they are all expressed as a percentage there. And just before I jump into the formula, just figuring out what do all these mean. Basically what we're doing is we're measuring profitability in relation to whatever the ratio is. So here we're measuring profitability in relation to equity. Here we're doing it in terms of assets, and here we're doing it in terms of our total revenue. So we're seeing how much profit is being made in terms of either equity, assets, or revenue. Okay, so let's have a look at our formulas here. It is important to understand our formulas because this helps us to write a little blurb in terms of what is happening with those ratios. So return on shareholders' equity, we have net profit over average equity. Net profit could be called net income, and average equity can be average shareholders' equity. Return on total assets, profit before, that's important, interest and tax. So sometimes we might have to add on tax or interest, as you'll see next. And over average assets, and then over here we've got profit before interest and tax over revenue. So we can see that the numerator of our equations are all to do with profit because we're dealing with profitability, and the denominators are specific in relation to the the ratio's name. So here we've got equity, and we're dealing with equity up here. Here we've got assets, revenue up here. Okay, so that's just a simple way in terms of remembering how to structure the formulas, and little hints and tips there. So again, we're timesing by 100 because we express these ratios as a percentage, as you see up here. So we know what they mean, we know how to calculate it. How do we tell if it's good or bad? So this is a measure of profitability. Basically anything that's a positive ratio, positive percentage, is good. That means we're making profit in terms of whatever we're measuring. Negative ratios are not so good here because that means we're losing money. So if you have a negative, it might be a good idea to provide a recommendation in terms of how the company could improve their situation. Now with these type of ratios, our profitability ratios, it's always good to measure against industry averages. Obviously in exam, if it's not provided, you can't do that because you can't go and research within an exam. But that's just a little hint and tip there. Okay, so what I've done is I'm using HiFi. I'm not going to go over the calculations on how we derive to the numbers. I've done that for you all up here. This is just going to be a nice succinct flow on from a previous ELA video going over ratios, and she also used HiFi. So here we've got our 3 section of ratios. I've calculated what they are for 2019 and 2020. We can see that for every single one, they're all positive. That's great. And there has been an increase, which is even better. Now, it is important to understand where all our figures are coming from so we can then start to create a story around it. So our numerator, the top of our equation, that is coming from our revenue point. So let's have a look here. So here is our revenue. Now I've got a little note here in pink and yellow saying net profit before interest and tax, because what I had to do here, we were only given the figure before tax. So I had to get the 448 and plus on our finance costs, which is our interest portion of 36.4, which you can see up here is what I've done. So let's have a quick squiz. What can we see as our major change in the past 2 years? Bam, right up here, revenue. It's gone up by about 800 million, which is huge. Okay, so that's something we would like to discuss. We can see our cost of sales have gone up, but that's pretty much assumed when you're going to have such a massive increase in revenue, because there has to be a cost to whatever you're selling. Expenses, they've all increased slightly, but nothing too dramatic. Our biggest thing we want to focus on talking about here is our revenue. Okay, so we're also dealing with equity and assets. So let's have a squiz down. Let's go down. Let's first look at equity down here. So this is an extract from our balance sheet. We've got a slight uplift here between 2020 and 2019, but it's also important to note that you are actually calculating the averages. Where's our major uplift? We've got retained earnings, which has increased here by about, let's say, about 80 million. We have had a little bit of a decrease in contributed equity, and our reserves have gone up, but retained earnings have increased, which sounds about right because we've had an increase in our income. Now, our last one is assets. Again, we know that's going up. It's an average. We need to do our little calculation here. So let's have a look at our assets. What's the biggest thing that jumps out to us? It is the rights of use asset that has increased. It's been introduced in 2020 for 642.2 million. So that's massive. Okay, so in an exam condition, how can we create a story about this information? So figures by themselves don't mean much, but when we put it to use, we can create our story. So this is the little story that we can create. Let's have a read. So there's been an increase of revenue of 823.6 million, which has been caused an uplift in ROE, ROA, and net profit margin. Cost of goods sold has increased as expected. Sorry about my spelling error there, with an increase of revenue. Expenses have slightly increased, but no significant changes identified. Why I'm saying no significant changes is there's been nothing too drastic that we can really discuss about there. You'd expect with more revenue, the increase in expenses is expected. In relation to retain ROE, it's still increased despite a minor uplift in equity. Equity has increased due to retained earnings, which is reflective in the increased revenue. ROA has mainly increased due to rights of use asset that has been introduced of 642.2 million. Overall, JB HiFi's profitability has had a steady increase from 2019 to 2020. So what we've done here is we've identified the biggest changes that have occurred, and we've said that they're profitable and it's increasing. So it's in a good trajectory. If that was decreasing again, as I mentioned before, we probably would want to include some recommendations as to how for JB HiFi to increase their position. But with this information, and this is all the information we have, that's the little story we can tell. Now what I've got here, I've got a note in green. So if this was your report, that would be insufficient. What you need to do is you need to dive deeper into those figures. Why is there now a rights of use asset here? What caused that to come into the scene? What caused that revenue uplift? Were people shopping for electronics more? Did anything external happen? So these are the stories that you want to tell within your report. But in the exam, we don't have that capacity to do the research. So just a short little simple story is great for this. So there we go, that's our profitability. Let's jump over here. This is basically what we need to know. There are tons of other ratios, but you can't learn everything. So I think learning the core is good and having a good solid understanding of what every ratio means. Our efficiency ratio. So we've got inventory turnover, settlement period for accounts receivable, accounts payable, and then our asset turnover. These are all expressed in days or times. Now the formulas I've used is days, just because I think from a discussion perspective, it's easier for you to discuss it in days. And I think it's a lot easier to understand. So Basically, what do all these mean? It's talking about how long does it take to, well, for this one, inventory turnover, how many days does it take to replace that inventory? And then it's all the same for each one. So this is how many days to collect accounts receivable, to pay accounts payable there, and then how many days it takes to earn revenue from your assets. So how do we know if it's good or bad? So let's just go over every single one here. So inventory turnover, the lower the number of the days, the more efficient. Now, inventory turnover, it's really important to consider what industry you are doing. So if you're in the business of, say, food, say Woolworths or Coles, their inventory turnover you'd expect to be very low because all the fresh produce, meat, veggies, all that sort of stuff will have to be turned over fairly quickly. You do have those long life shelf items, but because there's such a high volume of purchases, you'll probably see that there's a very high turnover. If we think about what's another industry, maybe a timber business where they, for construction, you might hold on to the timber a bit longer because construction builds take quite a while. So you might expect to see it slightly higher. Or if we're thinking about a car sales place, selling cars, you're not doing it as quickly as selling a piece of fruit, so it's going to be a bit longer there. So you really need to consider what industry you're looking at when you're providing a summary for in your exam, if this is on it. Then our accounts receivable one. Generally, I think a rule of thumb is payment terms of 30 days. So people generally want things paid back in 30 days. Sometimes you'll see it 60, sometimes you'll see it 90. Again, if this isn't an exam, you're not going to have time to research. So I don't see there's any issue in using that rule of thumb as a good measuring tool. So again, lower the better. So the lower means you're getting your accounts receivable paid back to you, so cash in your pocket sooner rather than later. Higher is probably not so good. It could lead to potential cash flow issues. So what I mean by that is if it's taking, say, 100 days to get your accounts receivable to pay you back, that means your income is being delayed in terms of converting to cash. So you could have some major cash flow issues there. And then let's have a look at accounts payable. So again, there's no perfect ratio for any of these. It's always dependent upon the industry. Generally, lower is better. But again, with accounts payable, it's something we need to consider is our cash flow. So if we're getting all our bills in and we're paying it straight away, whilst that is good to get rid of our bills, we're also getting rid of our cash. So cash flow is super important in order to determine when we actually pay our bills. We obviously want to pay it within those terms, but it might be better off paying them at the end of that time frame. So say if our terms were 30 days, we paid those bills at the end of the 30 days just to keep cash reserves in case of any opportunities or anything else we have to be liable for in that period of time. Then we've got asset turnover over here. So again, less days means that the company is more efficient in generating revenue from assets, and the higher is the opposite. You're going to see a lot higher in asset turnover. You're not going to see very low days here. It's generally going to be on the higher end, as you'll see in a minute. But you can always get more efficient, and less days is obviously a bit more enticing. So let's jump over into JB HiFi. I've done all these calculations. I'm not going to go through it because you're all masters of this already. This is just a refresher on a potential exam conditions and how you can convey your analysis. So generally, so this is our 2019 over here, and then this is our 2020. So we can see if we have a look, it's all getting slightly better, except for accounts payable. It's gone up, but by the tiniest amount. Accounts payable is super low, 12 days. So we might want to consider, okay, do we actually want to increase that for our cash flow management? Something to think of. Another thing that looks a bit, not concerning, but 100 days for accounts receivable is quite a fair bit. So we might want to provide some recommendations there on how to reduce those days. We can see it's already gone down by 9 days, which is wonderful, but I'd probably like to see a bit less there. Because we would like to collect our debts, so money in our bank, sooner than 100 days. Inventory turnover, so again, as I said, think about the industry. This is JB HiFi, so they're selling electrical stuff. To me, that seems pretty good, because they'd have to have quite a lot of stock on hand, and I actually think that's pretty good in terms of turning over electrical stock. And then we'll see asset turnover is quite high, but that's expected, as I said in that previous bit over here. So what I've got here our balance sheet. We've already had a bit of a look in our profitability section over here. We've seen those totals. But what I've done here is created a little story. So you can see the kind of things that we can write with just this minimum information. So let's have a read through of that. Inventory turnover has slightly decreased due to a reduction of inventory being carried on the balance sheet. So we can see here, inventory here has gone down by about over 100 mil, but obviously remember we're getting the average inventory, so that's a consideration. So we can see it has gone down. In addition, cost of goods sold has increased by 656 million, which is reflective in the revenue increase from 2019 to 2020. So let's jump over into our P&L. We can see cost of sales here has increased, and that's also the revenue increase. So JB HiFi had a massive increase in sales. Here, my note in green, this isn't part of my little analysis blurb. This is just something for you to consider. I've already mentioned this, but think about the industry the company is in. JB HiFi is in electronics. Thus, you would expect longer inventory days than, say, a company like Woolworths. Okay, so now let's have a look at settlement for accounts receivable. Again, I mentioned it's already a bit high. So what I've written here is it's already reduced by 9 days. That's great. This is due to a slight increase in both accounts receivable and credit sales. Credit sales is based on 10% of total revenue, which is an increase, so revenue has increased by over 800 million in it from 2019 to 2020. So we've got the increase there of our credit sales. Generally, the terms of companies is 30 days. JB HiFi is significantly above this. It's recommended to implement stricter credit controls. So what I've done there, I have identified that something doesn't look so great. And so because I've identified that, I've provided a recommendation in how JB HiFi can improve their position. You don't really need to do that if it's something that looks good. That, to me, the inventory turnover looks great. So let's have a look at settlement of accounts payable. So it's very low. There's been only a slight uplift in 2020 by 0.45 days, which is nothing. JB HiFi should consider the best use of cash in terms of managing their, that should say cash flow. Let's make that adjustment. It could be better for JB HiFi to extend the settlement period to keep cash reserves for potential opportunities. So we've got to balance those cash flows. So that's so whilst it is great, it could be slightly concerning that it's so low. So I have provided a recommendation saying it might be something for them to look at to manage their cash flow operations a bit better. Okay, lastly, our asset turnover here. So we have gone down by about 13 days. Asset turnover has seen an only slightly decrease from 2019 to 2020. I note that the slight decrease is due to an increase in assets in 2020. Remember, I talked about this in profitability, So which is the introduction of those rights issues down here of 642 mil. So you can see how I'm really diving deep into the formula. So I'm just looking at what made it up, average assets, and then I've gone in, dived in, and seen the changes. But this is also offset by the increase in revenue for 2020. So we're not seeing a massive change because that revenue portion here up the top has also gone up quite significantly as the same, like the assets have gone up. So it's recommended that JB Hi-Fi reviews their asset holdings and disposes of any assets that are not generating revenue or not essential to the business. So just getting rid of any assets that are just kind of sitting idle. Maybe you can get cash for those, and then you would improve your asset turnover ratio. Okay, so that's done on efficiency. All you're doing is you're looking at these numbers and creating a story. And how you do that is by determining what is the formula and diving deep down into the financials and then creating a story of that. Thank you. Last section, which is liquidity. We've got our two ratios, which is our current ratio and operating cash flow ratio. Again, here are our formulas here. We express them as A times. So current ratio, well, both of them, they're all basically measuring a company's ability to meet their short-term obligations, which is your short-term debt, current liabilities, with either your current assets here in the current ratio or your operating cash flow. And that operating cash flow is your net operating cash flow. If we have a look in JB Hi-Fi, oh, here we go, is our net cash from investing activities. Well, it's actually a cash outflow. Net cash inflow from operating activities in your cash flow for JB Hi-Fi. So these are our two ratios. They basically measure our liquidity position of a company. With our current ratio, anything over 1 is good. What does that actually mean? It means that our short-term obligations can be paid within a year. Anything under 1 means that they cannot cover their current debts with current assets. So you really want to aim for a ratio over 1. Again, you would be comparing to your industry averages, but in a potential exam conditions, you're not going to be able to research. So rule of thumb is 1 for current ratio. Operating cash flow, basically the higher the better. So the higher it is, it means that the company has generated more cash, which it can use to pay off their current debts. So let's jump into our JB Hi-Fi. What I've done for you here is done the calculations again for you, 2019 and 2020. Firstly, we can see current ratio has decreased. So it has been a positive over 1 and now it's gone under. So that's a bit of cause for concern. What's our major change here? It is our current liability, which has gone up. Let's dive deep into our current liabilities. Here we go. Where are our changes? We've got 2 major changes. 1, there's a pretty big increase in our trade and other payables, and then 2, we've got those lease liabilities introduced. And then over here we've got our operating cash flow, so it's our operating cash flow over average current liability. So here it has increased, which is wonderful. So operating cash flow has increased quite a lot. So let's have a look at our cash flow. Oh, sorry about that, over here. So we can see it has increased from 2019 to 2020, and that is mainly due to our receipts from customers. And if we think back to our P&L, we have had an increase of revenue of over 800 million. So that is great to see that it's following on in our cash flow statement. Average current liability again has slightly increased, and that is due to what I said for the current ratio. You can see it's slightly different because we're looking at the average current liability, whereas over here we're just looking at the current liability, so for the actual year. So what have I written over here? So let's just have a read. Current ratio has decreased. JB Hi-Fi is no longer able to meet their short-term debts with current assets within a year. The decrease is concerning. The main reason for the change is an increase in current liabilities from 2019 to 2020, which is associated with an increase in trade and other payables and also lease liabilities. So we already saw that below. So it's bad. So let's provide a recommendation. JB Hi-Fi should review current liabilities and determine if there are any current debts that can be paid off now to reduce their position. So have a think of any other potential recommendations you could make here. Then let's have a read of our operating cash flow ratio. So it's increased, which is due to an increase in revenue, which has increased the receipts and customers from the operating cash flow. So as I mentioned, that is because we've had an increase in revenue from our P&L from 2019 to 2020. So JB Hi-Fi should continue to improve their revenue through sales strategies. So you can come up with whatever other recommendations you can there to improve their position. But that's done. that one's a fairly nice one because you've got that tool of 1 for our current ratio here, which is our gearing section. So we're just going to look at the gearing ratio here. It is expressed as a percentage, so you probably do need to times that formula there by 100. So there's our formula. Basically, what does it mean? It looks at how the company is leveraged. So it compares our equity to borrowed funds of the company. So down here, we've got a little rule of thumb. How do we know if it's good or bad? It is basically, again, based on industry, but we do have a little bit of a rule of thumb here. So if it's over 50%, it means that it's highly geared, which means that the company has higher debt than equity. So it means it's at a greater financial risk. If it's lower than 25, that means it's low risk. Why? Because there's more equity involved there. And then where's our middle ground where we're generally happy? It's between those 2 points of 25 to 50%. So it's our optimal level where there's a good balance of debt and equity. So we probably don't want to be outside those parameters of under 25% and over 50%. There's always a balance in terms of debt and equity in which we want within a company. So let's quickly apply this to our JB HiFi. So what I've done is I've done our calculations. You can see there we're sitting around the mid-30s for our gearing ratio, which is great. It's optimal. It has increased slightly, so it means that we've got a bit more debt involved in 2020. Let's have a look over here in our non-current liabilities. We can see that there's been an upward shift of about 123 million. Equity has got a slight increase. We have previously talked about that in this video here, but let's just have a read at what the gearing story is. So the gearing ratio is sitting at a generally optimal level. It has increased slightly, indicating the company is more leveraged with debt. Non-current liabilities have increased due to the introduction of the lease liabilities. But there's borrowing of 439 million that has been paid off between 2019 and 2020. So we're not getting a drastic increase because those lease liabilities are 577 million, because you see up here those borrowings have been paid off. So that's kind of offsetting it a little bit. Equity has slightly increased due to retained earnings, which is reflective as there is an increase in revenue in 2020. So there we go, that is gearing done. I think, as you can see, as I've discussed every single section, our profitability, equity, liquidity, and gearing, you can see that there's a very common theme in what impacts the financial ratios. You can see that I've discussed the increase of revenue, the increase in those lease liabilities, and let's have a look at what else I can see. So that is our increase of revenue. Our cost of sales have increased, but that's expected with an increase in sales. What else around here? Again, our increase in non-current assets of our rights issue there. So they're basically our main points that we can see that has impacted our changes in the cash flow in all the ratios, for 2019 to 2020. So you can see with all those figures, we've now created a little story of how the financial position of JB HiFi, and that is something that you could expect to see on the exam, and which you have already done within your report, although you have done a lot more research behind it and backed up your statements. Thank you.